to you on deposit modeling. It's a little after 3 o'clock, so I think we should get started. We have most of the people who are signed up for the webinar on the line. So we would ask you to just bear with us while we go through the introductory phase of the webinar. So once again, thank you for joining us. My name is Andy Paprava. I'm the Senior Advisor at BB Analytics. And as well, joining us today will be Sohail Farouk, who's the Chief Executive Officer. So welcome. Today what we're going to do, Sohail, if you can advance the slide, we'll talk a little bit about some We'll be talking a little bit about some housekeeping matters. Okay, if we could advance the slide, that'd be great. There we are. So there's our contents. We're going to talk a little bit about some housekeeping matters, talk a little bit about the main sort of messages that we want to convey today. We'll be talking a little bit about deposit dynamics and how to better understand them. Done some survey work with respect to traditional ALM modeling approaches. Talk specifically about deposit modeling and the analytics that go along with that. And in the appendices that will provide you with the takeaway that you've already got, hopefully a copy of the slides, some discussion around the risk taxonomy, as well as some information about BB Analytics offering. So that's the agenda for today. So moving on, we'll just a few housekeeping announcements, if I could. And so obviously, happy to take your questions anytime. You can do that one of two ways. I'm not sure, Sohail, if we've opened up the mics, but I'm happy to do that if people want to jump in on and ask a question verbally. Or if you're more comfortable, you can enter your question on the right-hand side of your screen. You should see a chat box, and you can enter your message there. Or you can send me an email as we go through. My email address is there. If you don't have it, we'll pop it up again. We are recording this webinar, and we're going to offer the recording to be made available at our YouTube channel at the following link, which again you should have with respect to the material that you've received before this webinar. I hope that's okay. If there's any questions, happy to take them now on that. In the meantime, just a quick word about Sohail and BB Analytics. So over to you, Sohail, for an introduction.
Thanks a lot, Andy. Welcome, everyone. So I'm pleased to welcome our international attendees for the first time. So historically, we've been offering webinars to credit unions in Canada. This time around, we have some credit unions from the US as well, and a few international banks too. So welcome, everyone. Banking Book Analytics was set up in May 2018. So essentially, as the name suggests, we are an analytics firm focusing on advanced credit portfolio management, credit-adjusted ALM, liquidity, cyber risk, and funds transfer pricing. We tend to serve mid-sized financial institutions, so that bracket of institutions includes credit unions, insurance companies, banks, and specialized lending institutions. Our offering is organized in two broader cohorts. The first is essentially software applications. These are our pre-built solutions, which we customized for our clients using agile software development. And the approach is very unique. We do not offer any black boxes. All our approaches are auditable and are very transparent. We work very closely with the clients to develop rigorous user acceptance criteria, and then develop models to get the clients buy-in and to be able to get those models also accepted by the regulatory authorities or get them accredited. On the other hand, we also offer consultancy support in areas such as balance sheet design, adjusting or bridging the data gap for modeling purposes, and so forth. Thanks, Andy. Oh, Andy, you there?
Sorry, Sahil, I was just going to ask you to comment on the next slide here with respect to
Okay.
the diversity of the business.
Yes, yes. So we are, of course, we are based in Toronto, Canada, but our footprint is essentially very international. What we provide to the clients is boots on the ground. So mostly our consultants and our developers are on the ground trying to understand the challenges that are complexity of the challenges that our clients face and how we can address those. Some of the examples of the work that we are doing, for example, at the very moment, are really working with an emerging market housing authority to set up a housing bank. This is sort of course, a bit more strategic, but on the modeling side, we are developing risk capitalization models that can be used for internal capital adequacy assessment purposes, liquidity models, as well as the credit rating models. These are some of the examples.
Thank you, Sahil. And that speaks to the capacity and the expertise in your team. So moving along, we're just going to talk a little bit about the key headlines for this webinar. The purpose of this webinar really is generated by the fact that things are changing in the market. It's been 9 months since the interest rate environment has started to change. It's obvious that the interest rates increases is going to have some impact on the economy, including what we're seeing now in terms of volatile markets, as well as the proposed or the projected economic slowdown. The GDP is expected both in North America and elsewhere to slow down a bit. And of course, this has implications for financial institutions around the world. We recognize that there's going to be trade-off between interest rate risk and credit risk, and the question then becomes how do you optimize the value of deposit taking and how that whole process is going to work going forward, and what frameworks best address such trade-offs. One of the things that we've noticed is that some of the current systems in place, vended or in-house, may not address repricing risks of deposits, and I think that's going to be a major issue going forward. One of the things that we think about is trying to figure out how do you characterize deposits for each institution, and what the risks associated with those characterizations are, and how are we going to optimize funding and liquidity risk going forward. And I think one of the things that we want to express today in our discussion is how you could use analytics to develop near-term tactics and short-term strategies. Obviously, starting with the hypotheses about where the market will go, and then obviously talking a little bit about optimizing liquidity and profitability, and then generating some discussion around predictions over time. So that's really what we want to talk about today. Hopefully that meets your expectations, and I'll pass it over to Sahil to talk a little bit about some of the key aspects of that. Sahil? Over to you, Sahil. Can you advance the slide there?
Yeah. So Andy, thank you so much. I think the fundamental question that we're trying to answer is the rate increase, does it present an opportunity for the credit unions in Canada and, of course, the US? And how can the credit unions capitalize on this opportunity? So these are, of course, two of the important takeaways that we want to develop. And as Andy's mentioned, the starting point is really understanding what is the optimization that exists between the supply of the liquidity and the utilization of the liquidity for the credit unions, and then try and sort of create an optimal point, not just from a liquidity versus profitability perspective, but also from the perspective of earnings. And in other words, are we incorporating the adequate premiums for the credit risk?
you go to the next slide, we'll see. Right, Sohail, you have, oh, there it is. There it is. There's good news and bad news, Sohail. Tell us about the good news first.
Well, the good news is that the deposits, of course, have moved back into the system. We've seen some attrition from the wealth managers. We've seen also the attrition or the flow of deposits from the stock markets. And there is more evidence that has come out with regards to the betas or the adjustment that the big banks actually provide, pass on to their saving holders. So what we've seen is that, for example, south of the border, U.S. banking industry, they have increased the costs associated with the interest-bearing deposits to 49 basis points, or above 50 basis points, from 36 to 40 basis points in 2017. So that shows the kind of attraction or the kind of competition the credit unions are expected to face. But that being said, the challenge is that what is the stickiness of the deposits that the credit unions have currently? What is the flow of the deposits, and understanding that where the deposits are coming from and where they are going. So that's really an important part of the analytics, and of course, a very simplistic analytic that we want to look at. But on the flip side of it, although the deposits have moved back into the system, the historical observations do not tell us much. The risks are, of course, emerging. As we said earlier, that one threat is, of course, external, which is from the banking institutions, that they are overpaying for the deposits to attract the liquidity. The second, of course, is that there is a likelihood or a chance that the defaults, especially in the credit business, are going to go up, and how that is going to have an impact on the lending side for the credit unions. Is it going to slow down the intermediation business for the credit unions? And then if it does slow down, is there a threat for margins to get eroded? So those are some of the important headwinds that need to be countered.
Well, let's talk a little bit, Sohail, about a better understanding of what's going on with respect to the deposit side.
Yes. So, of course, deposits are a hidden source of value for credit unions. The challenge is, how do we value them, first and foremost? And then how can we capitalize on this particular value that the credit unions have? So within the current modeling environment, how are the deposits being treated? That's another dimension that we would be looking at. And then we would move into the prediction challenge and the funding challenge from the perspective of the deposits. So as we said earlier, that the rate-driven market is, of course, not standing still. It is rapidly evolving. The competitors are actually using sophisticated measures to attract the depositors. There's new competition that is coming in the form of fintechs. And they're also going to be actually becoming an active player. So what is the threat to the core business or the core deposit business of the credit unions? The first and foremost is that credit unions, are they expected to overreact to this environment and increase their betas, or would like to keep their betas consistent? But in order to answer this question, what is important is that we need to understand that what sort of maturity horizon or the duration of the deposits exists within the credit unions. And then, of course, the second and important aspect is to be able to understand the cost of such deposits so that the funding spread as well as the default spread can be adequately addressed. So these are some of the important requirements that we need to develop so that they can become part of a transfer pricing framework, which then creates the value for the credit unions, and that is how it gets communicated to the stakeholders and delivered to the stakeholders. Any questions here?
No questions showing up unless somebody wants to jump in and ask anything that they want to ask at this point. Well, let's move on then.
Okay. I think under the current situation, what we have is a knee-jerk reaction, which says that the competition is increasing the returns or the pricing for the deposits, i.e. the betas are going up. Should we also increase the price of the deposits? And the answer to that is that we need to be able to understand that the motivation to increase the deposits is a function of the funding, and of course is a function of the return. Are we aware that the business unit for the deposits or is motivated by the higher cost of deposits? So in other words, that the branches might be profitable, but is this profitability also going to get transferred or transmitted to the stakeholders? So the key risk here is that of the mispricing of the deposits. So if the credit unions panic, increase the pricing for the deposits, that may have an adverse impact on the returns attributed with regards to the asset side. But how do we address this challenge? Of course, the important thing here to understand is the cost of fund or the cost of the deposits. And then in the midterm, what the credit unions need to do is that they need to understand the deposit flow over time. As you talked earlier, the ALM assumptions in the deposit flow are an important starting point. So looking at your current ALM systems and trying to understand that's how the ALM systems or what kind of maturity horizon or duration the ALM systems have given is an important part. Now, within this context, it becomes important that we backtest the projections or the estimates for the forecast of the deposits which were given to the credit unions by the ALMs. And how do we validate the deposit maturity which was given to the which was provided as part of the ALM systems? So one key metric is, of course, backtesting, and a great way to backtest is through root mean square error, RMSE. So RMSE is the square root of the sum squared difference between the estimated values or the forecast values and the actual retention value of the deposits. If your RMSE is lower, that indicates that there is a closer match that exists between the forecast and the actual values. So hence, the forecast would be accurate. Now we've seen that some benchmarks that exist for the non-maturity deposits range anywhere from 3 to 8 years. OCC assigns a 3-year term to the deposit maturity. We've seen 8-year examples as well. So those are some of the things that deposit unions, the credit unions need to adjust. And finally, how would the credit unions design the balance sheet? A good starting point is looking at limiting reliance on the securitization. There has been a lot of discussion around the inherent risks that the securitization brings, and focusing more and more by relying on deposits. So those are some of the things that, of course, are inherent advantages that the credit union systems have has in Canada and should be capitalized upon.
So Heal, one of the things that, sorry, go ahead.
Yeah, go ahead, please.
I was going to say, one of the things that from a strategic perspective, credit unions have been very focused on over the last generations, really, is making sure that their deposits are very sticky. In other words, that the members have got a high level of loyalty to the credit union. When you look at these this long-term view, adjusting the balance sheet to maximize the value, what other sort of considerations should a credit union have with respect to making sure that the stickiness continues? There must be, other than building models and looking at the way credit unions operate, is there any other mechanisms that they could use to sort of validate, I'll call it, their historical experience?
Absolutely. Andy, there are some emerging technological solutions that would allow credit unions to enhance the loyalty factor. the convenience, such as associating themselves with the e-wallets, making sure that there's a conversion that exists between the variable rate customers to a fixed rate customer. So that conversion part becomes very, very important. And then another key aspect of retaining the deposits in the system or within the credit union and to drive the loyalty is to run some high-level analytics. That what is driving the outflow of the members from the credit union, and how that can be prevented. Now, this is all beyond modeling. These are some very simple incremental steps that the credit unions can take and understand the behavior of the members and try and sort of address those.
Great, thanks. Please carry on.
So moving on, as we set the stage, we mentioned that deposits have an inherent value for the credit unions. Of course, there are external pressures to pass on the rate increases to the depositors, but is it really solving the problem? Or what the problem is that we have probably not diagnosed it correctly. So the problem that we have within the credit union system is twofold. The first is that we need to be able to understand the characterization of the deposits so that we can accurately understand their repricing behavior. The second is that we want to be able to know that what is the balance or what is the core piece of the deposits that exist, what percentage of that. And third is, of course, to attract the new money. And really this sort of transcendence from the current stage to the end state is not very simple. This has to be done in an organized way using a formal internal planning framework. And the starting point really is driven by understanding what kind of cost, as we mentioned earlier, cost curve are the credit unions on. So in other words, is our transfer pricing framework understanding the repricing behavior of the deposit holders? So if I were to actually put it in a more quantifiable way, that on the receiver side, credit unions are receiving the fixed rate for the fixed term, but on the payer side, the credit unions are paying the variable rate. So that discrepancy that exists between the variable leg and the fixed leg needs to be bridged. A great framework can be used, which is essentially a swap curve, to be able to bridge that. And that could help credit unions identify very, very quickly that what kind of repricing risk that exists and how it can be incorporated into the transfer pricing. Secondly, on the quantum side or on the balance side, as we mentioned earlier, the high yield should be really focused on the fixed term, and where there are almost 0% payments, that could very well stay in the core or indeterminate maturity deposit pool. But at the same time, that core pool needs to have its own maturity or duration determined. And finally, this can itself become a business proposition for the credit unions at the branch level, at the liability management level, that can be utilized from a profitability perspective. Now, how do we get there? How do we move from point A to B and then to point C? Or in other words, how do we apply our technical suggestions to a midterm solution and to an end state? As you mentioned earlier, that the repricing modeling is, of course, a challenge. It needs a lot of data, but at a simpler level, it can be completed using a swap curve. Second is the characterization over and above the rate part and the balance part becomes important. So some of the existing ALM modeling approaches can be used to be able to determine the core piece of the deposits. And finally, once we have that analytic in place, the modeling analytic in place, we can then derive and build a strategic value proposition for the deposit attraction. Questions here?
No, I think we're good for now. Keep going.
Okay.
Thank you.
So I think the basic building blocks for the credit unions can be put in place by developing some quick fix modeling approaches. As we said, that there are some benchmarks that exist to determine the maturity horizon, that they range from 3 to 8 years for the core deposits. We talked a little bit about the payer side and the receiver side. On the receiver side, credit unions are basically receiving the fixed rate. On the payer side, they're paying the variable rate. But there's one piece of puzzle that is still missing, and that is the credit spread piece. So for credit union to be able to determine adequate return, which is expected by the key stakeholders, the credit spread piece becomes extremely important. We talked a little bit about the ALM modeling. We said, what is the administered rate curve on which is used by the ALM models? So in other words, are there any beta type adjustments that the credit unions make as the rates go up? The second part is, are the credit unions pricing the default risk every time they transfer funds from the sources to the users? So that is also an important part. How do you incorporate the default risk? This has been a focus of our discussions in some of the previous webinars, which are, of course, available for you to listen on the YouTube channel. But simply speaking, that essentially implies that the credit unions need to have credit risk models, which would actually then allow them to be able to understand that what part of credit fund is funded through the deposits and what part of credit is funded through the member equity. So what is really the weighted average cost of capital? So that would allow credit unions not just to be able to incorporate the funding spread or the deposit spread, and then the repricing spread, which is really compensating against the interest rate risk, but it will also compensate the credit union members for the credit risk that they take.
So here's a question that's been raised. How do you develop that reference rate curve that you've got on this slide? How does a credit union do that?
Yeah, so this reference rate curve, as we said, is really a function of the market movement of the interest rates, and also is path dependent with regards to the repricing behavior of the depositors. There are some options that exist in terms of its development. Some of those could be really around a single factor model or a multi-factor model. Within that, there are, again, ranges of models that can be developed. These are somewhat technical approaches, but having an internal administered rate curve would allow credit unions really to be able to not just use from a funding perspective, but also to be able to use it from a transfer pricing perspective, so that they can discount their maturing assets and liabilities as they emerge. Now, we talk more about the determination of the administered rate curve in subsequent slides. So I would leave that for now, and we will address it when we get there.
Thank you.
Okay, so in the current state, I think we're looking at some of the ALM modeling options, and what we did is we actually surveyed some of the ALM modeling options, and within the specific context of how they treat deposits, unless there are some assumptions that the ALM models make, with regards to treatment of deposits, these static ALM modeling approaches are not really the best tools to be able to understand the value of deposits that they have on the economic value of equity for the credit unions. Inherently, there are two challenges that exist. The first, as we discussed, is that lack of understanding with regards to the cost associated with the deposits. The discrepancy that we talked about, on the funding side, and then on the use side of the funds, i.e., receiver and payer, receiving fixed, paying variable. That is the one challenge. The second is on the quantum or on the balance, as we said, lack of understanding with regards to the core and the volatile pieces of the deposits. So these two are important challenges that are not addressed by the static ALM models. And so what we've done is we've kept them here for your reference. And of course, without going into the details associated with regards to these ALM models, what I propose is that we move to the next slide so that we can discuss what are the shortfalls of these static ALM models and how they can be addressed by an adequate liquidity planning approach. Does it make sense, Andy?
Yes, by all means. And I just want to ask a question I'm sure people are thinking about is, does that mean that my current ALM modeling is not good enough for this purpose, or it means that the models that you're talking about here would go the next step above what they're using, what potentially credit unions are using today? So I just want to make that clear, because I think credit unions are quite satisfied in many ways with their current systems and modeling from their perspective in terms of ALM.
That's a very good question, Andy. And as I said earlier, our objective is not to outrightly dismiss the ALM models. What we are saying is that when it comes to the current ALM models and the current approaches, what the credit unions need to do is they need to be able to backtest the forecast with regards to the retained balances of deposits. So what were the forecasts which were made? Or the estimates that were made, and what actually really transpired. I think that's very easy to do. If you can go back, say, a stretch of period, let's assume 8 to 10 years, to be able to see that how the ALM models forecasted the retention piece or the core piece of the deposits, and then using a root mean square error approach, credit unions can be able to validate the assumptions behind these models. That is, of course, one side of the dimension. The second is, as we talked earlier, is around the administered rate or the yield curve for the credit union itself. Now, every institution has a very specific yield curve, and that yield curve needs to be modeled as well. As we said, that in the absence of such a yield curve, is there any sort of no arbitrage type approach that can be used? And we mentioned that could be a swap curve. So those are some of the things that credit unions can do under their current framework. But that being said, of course, these models do have some shortfalls, and one of them is understanding that whether or not there are any what-if scenarios that exist. So the key challenge is not just by stressing the yield curve by 200 basis points or 300 basis points to determine the sensitivity and the impact on the equity itself, but also to be able to understand that whether or not there are what ifs and they're addressed, by these models.
Terrific. Thank you for that explanation.
So those what ifs are really the key requirement, when it comes to the dynamic liquidity planning. And the role that the deposits play is extremely important in dynamic liquidity planning. From a credit union perspective, the sources of liquidity, of course, are deposits, and the second is securitization. Let's say in the absence of securitization, that could itself be a what if, from a credit union perspective, what dynamic liquidity planning exists for credit unions. What is the survival horizon from that perspective? So those are some important requirements that need to be dealt with. And there are approaches which are available under the dynamic liquidity planning that would allow credit unions to understand what earnings are at risk for them, and hence, the profitability or the risk associated with margin erosion can be modeled using the earnings at risk type approaches. So that's really the sort of the thrust of some of the next few slides.
Excellent. Let's move on then. There's no other questions at this point.
Okay, so we identified two particular challenges. One is, of course, the cost of deposits, understanding what is that. The second is really the retention or the core balances of the deposits, and of course, as a result of that, the volatile balances of deposits as well. And to be able to model those two questions, what we propose are two approaches. The first is somewhat more complex, but of course, very elegant solution, and it allows for credit unions to be able to model the path dependence or the repricing behavior, from that perspective. The second is what we would call a numerical method, essentially looking at some of the no arbitrage type portfolios or the fixed term bonds and applying them to be able to see what kind of sensitivity the deposits are exposed to and what kind of value do they incorporate to the overall equity of the credit unions. So those are some of the approaches that are at a very high level. I would like to actually dive in deeper into the option number one, which is essentially the administered rate modeling approach. Now, administered rate modeling approach computes the potential future interest rate paths, which are really a function of the exogenous movements of the yield curve. So in other words, the situation that we are in is really a great exhibit and application of the yield curve movement and how that could be applied. Yes. So that being said, we talked earlier that how can we identify the characteristics of the products, and then the behavioral aspects associated with the depositors, and finally the cash flows which are attributed to these depositors. This then brings us to the development of a proxy portfolio. Now, a proxy portfolio essentially is really the replication approach, and some of those who've actually studied options, it is a very, very common approach from an option valuation perspective, which is, could be a rate-based trinomial lattice, or how what canonical instruments exist which can be used from proxy perspective. So to give you an example, a zero coupon 5-year bond, is this really the closest proxy that is available from a modeling perspective to the deposits? A floater or a floating rate note, from that perspective, could be used to model the volatile balance of the deposits. Now, on the flip side of it, as I said earlier, that what we've done is we've actually developed a numerical approach as well, which is somewhat easier to implement and very quick to implement as well. So here, the starting point is really to develop the core and the volatile balances. To give you an example, going back 8 years or 10 years and looking at month-to-month balances and looking at the delta attributed to those balances. Now, that being said, a thought that comes to mind is that are these balances, can they be closely replicated or mapped to a financial institution, a financial instrument? A good example could be, is this really a preferred share, or is it reflective of the yield associated with the preferred share, or a perpetuity as it is known as in finance? So that can give us some kind of indication of the maturity horizon or the retention of the core deposits. And
so
that,
sorry to interrupt, but there's a question here that's come up. This looks like this modeling approach would require significant amount of data. How do you respond to that concern or question?
Yes. So that's a great question. I think there is, of course, data requirement, and data requirement has two dimensions to it. One is really the internal data. As I said, the internal data that we are talking about is really with regards to the balances associated with the deposit accounts. And the second is external data. Externally, what we are trying to do is we are trying to model the administered rate curve. So that external data is also extremely important. And then the third piece is around the parameterization of this model. Now, the objective for today's presentation is not to get into the heavy-duty quantitative aspects associated with such modeling. But yes, the complexity does exist from a modeling perspective. But with regards to the data perspective, I would say that this is less data intensive compared to the credit risk modeling, Andy. So I don't know if that answers the question for the questioner or not.
I think it does. Thank you.
Yeah, thanks. So I think where we were was really trying to map the cash flows with the core or retained deposits to the canonical instruments or the fixed rate bonds that exist, in some of the cases, zero coupon bonds and the floating rate notes to describe the more volatile balances. This does allow us to then use the duration gap approaches to sensitize to understand the interest rate sensitivity and the repricing behavior of these deposits, and hence identify what value do they provide with regards to or what value do they contribute to the economic value equity modeling as well as the earnings at risk modeling. Okay. So moving on, this is really a summary of our administered rate approach on one slide. As we said earlier, we have the repricing modeling for the repricing characteristics. We talked about the variable versus the fixed. Then we have the balancing characteristics. We talked about the retained piece or the core piece of these deposits versus the volatile piece. And then, of course, map it to the proxy portfolio and run a scenario simulation. You can run 1,000 scenarios or 2,000 scenarios using a Monte Carlo, and then identify, what kind of EVE or earnings at risk contribution is there from a depositor's perspective.
So on that point, if I could, on the scenario simulation running a Monte Carlo system or projections, what kind of confidence level would you come up with that would be reasonable in this sort of an approach?
That's a very good question, Andy. So I think the confidence level is really a function of the risk profile or a desired risk profile for the credit union. Is the credit union a great way to look at it is also that what is the inherent risk profile of the credit union? Now, in the absence of externally rated credit unions, how do we identify that what is the risk profile of a credit union? Is cost of funds a good proxy to determine whether or not the inherent default risk attributed to credit union is taken into consideration? Or is there another sort of marketable instrument that is available that can be used to really map a credit union with regards to a risk profile? So some examples are really looking at, say, a credit default swap curve. A credit default swap curve is essentially an insurance premium that the funders sort of pay to ensure the obligations that they've issued to a financial institution. So these are basically traded sort of instruments, and if a credit union can map itself to a certain CDS curve, they can, by virtue of their cost of deposits, they can identify very quickly what risk profile they're at. Now, having said that, once they've identified the risk profile, then that can be used really to model the minimum economic value of equity required by a credit union at a certain confidence interval.
So how does that relate to the ICAP? Just out of curiosity, because it's certainly not something that we see in credit unions across the country, at least in Canada, elsewhere perhaps, as to how the evaluation of the required capital, either from a regulatory perspective or from an economic capital perspective, relates to this whole issue that you've just described. How does that work?
Well, that's an excellent question, Andy. And really, I think in our previous two webinars, we addressed this question at length. And ICAP, as we said earlier, is really sort of a function of the risk profile of a credit union, and then what quantum of capital at a certain confidence interval credit union is willing to hold. So if you look at, say, Basel II modeling, Basel II modeling essentially is at a confidence interval of 99.9% confidence interval. So in other words, what it says is that it is mapped to a AA bank, AA rated bank, or in other words, once in 10,000 years, there could be an event risk, that can have an impact or that can sort of liquidate the financial institution. That being said, how accurate that model is of course challenged by the past events of 2008. But really, from a modeling perspective, and using the risk profile as a proxy, which then gets upstreamed into a risk appetite, which is a key requirement for ICAP, is a very, very important part. And I think the rates, the cost of funds rates or the cost of deposit rates mapped to a credit default swap is a great way for credit unions to benchmark that where they are relative to the external world, which is constantly rated and which is traded, on a regular basis.
Yeah, that's an excellent, linkage between the two concepts, because I do think that one of the issues that everybody has is this issue of identifying how much capital is required and how do you measure the risk appetite, risk profile of an institution, any credit union or other institution today. And this whole approach, I think, validates, if I could say, that whole ICAP process. So I think that's great. Thank you for that.
You're welcome. Okay, so now this is, of course, the numeric method or numerical approach that we apply. And as we said earlier, the starting point here is really determining the retained balances in the face of rate increases, understanding what was the historic beta or what was the historic retention proxy that can be applied, and then slicing and dicing it into volatile balances and the rate sensitive balances at a certain confidence interval. Once we have completed this exercise, the next stop then becomes understanding that what is the pair versus the receiver swap curve or a swap that can be used. That gives us a good idea about the rate, and then we can sort of identify the proxy portfolio and use that as the basis to determine the sensitivity, the decay, the average life, and all the other sort of requirements which are part of the transfer pricing framework, and that can be used to discount the maturing assets and maturing liabilities on a go-forward basis.
Well, here's another question that's come up. Deposit brokers, more and more credit unions are using other channels to bring in deposits. Obviously broker deposits are a bit more volatile than the other ones, the other core deposits that you might bring in through the branch system or some other way. How given that there may not be a lot of data going back 5 or 10 years or whatever on usage of using broker deposit or brokers for deposits, How would you go about modeling that going forward? Is there sort of another benchmark that you might be able to use?
Andy, that's a great point, actually. I mean, I think the brokerage deposits is something that of course, you can apply the same framework, but as you've said yourself, that the retention piece for such broker deposits, or the volatility, is expected to be higher. In other words, the average life for the broker deposits may be much less than the member deposits, which are originally sourced by the credit unions themselves. So yes, we can use the same framework, but I think our hypothesis is that the average life would be much less than the deposits originally sourced by the credit unions.
Thank you. So there is a way. There is a way to factor that into this model.
Absolutely. We have to look at it from a segmentation perspective, and I think the more segmentation that we can create, the better it is from an analytical perspective.
Thank you. Let's move on, because we're sort of running out of time a little bit here.
Yes. So I think we're almost nearing the end of this presentation, but what we're trying to do here is that, this is really deposit modeling in action. As Andy has mentioned, part of this could essentially be your broker deposits, and we're looking at sort of the current versus the time deposits and so forth, and mapping them on the administered rate curve, which would allow us really to be able to determine the average life associated with the deposits. The core piece, which is associated with the deposits, gives us the insights. Where do we invest? For how long do we invest? Can we rely on this money? And of course, the most important part is what kind of earnings we can generate. So what is our net interest margin associated with these? Okay, so just quickly jumping into, and these are, of course, the key piece of the presentation is complete. But what we're trying to demonstrate is that once you have this modeling prowess with you, you can use that as the basis to develop additional analytics. We talked about now, this is a great example from one of our previous engagements where we're looking at earnings at risk, by using essentially the deposit modeling, and then, applying it. Some of the other examples are you can design your balance sheet liquidity, and it is important to understand how you can design the balance sheet liquidity, and what kind of control it provides you. Again, this is also an early warning indicator with regards to the volatility. As the volatility goes up, you can then apply more and more stresses into the liquidity. In the absence of volatility of the balances and higher core retained parts, essentially, the liquidity itself is well managed and could be considered as on the lower spectrum of the systemic risk. And finally, of course, as we, in the beginning of the conversation, we talked a little bit about the liquidity and the profitability optimization. This is a great example. It gives you great insights. How much do you pay, and what kind of margin do you generate? The key message here is for credit unions not to leave money on the table. And that is really what we can foresee could potentially be the challenge of the emerging, some of the emerging sort of challenges as are the opportunities.
Before you leave this slide, Sahil, could you just go back to the slide for a second, the previous one for a moment? Just want to make sure that we understand this, the left-hand side of this slide here. You say deposit rate paid and net interest margin for two top Canadian banks. Could you just explain what the difference there is? Because I'm not sure everybody would understand that. I certainly don't.
Yeah, certainly. So essentially, this is really a sort of an analysis that we've done based on the publicly available information, with regards to the net interest margins, and yet how much sort of was paid to the savers or to the providers of the funds by the bank. So this is, again, an example of how modeling of the deposit retention can provide you with the analytics that you would be able to, with the confidence, move to the next stage and earn the same margin by paying them the less. So in other words, the bank which is in dark blue is essentially at a higher margin, from a technical perspective, because it is paying less to its depositors.
Oh, I see. Okay, thank you.
You're welcome. Okay, and finally, I think just a quick sort of showcase of what is it that we can do very, very quickly for yourselves. We can provide you with the core or retained deposits indexation. This could be a subscribed service. So essentially, it would allow you to actually apply these retained deposit balances in your ALM models. You can override your ALM models maturity assumptions. And then you can also generate additional reports. You can incorporate these deposits to develop earnings at risk or ALM, economic value of equity. And they're also, of course, can be used from an ALCO's perspective to develop additional analytics. Finally, we can also assist you, as we said, on the numerical side, on the hedging advisory, looking at your short on the variable side or the pair side, and long on the fixed side or on the receiver side. We can advise what kind of hedging your institution needs, and that's sort of my colleague Mark Gibbs and I we work in that particular space. And then finally, once we have the core deposit information, we can also advise you with what are the replicating portfolios which you can apply really to be able to model these deposits and to determine the sensitivity associated with your deposit balances and how frequently do they reprice and so forth. This, of course, is on the modeling of the administered rate curve that Andy talked about. In the interest of time, we are going to skip this piece, but essentially, the key message here is that we apply principal component analysis to develop the administered rate curve. Our work has shown us that we can model up to 98%, with the one-factor approach, or describe the yield curve with the one-factor approach. So that's fairly high. It applies to some of the other countries as well. So if you're interested in this type of advisory, we will be very happy to provide you with that.
Well, thank you, Sohail. We have exhausted all the questions from the group so far. If there's any other last questions, we have a couple minutes if anyone wants to type in or jump in on the conversation. Happy to take your views or comments. Meanwhile, while we're saying that, I just remind everybody that this webinar has been recorded and will be available on the YouTube channel for Banking Book Analytics, which we sent to you earlier. So feel free to share that with your colleagues and folks in your credit unions and elsewhere. So, so I don't see any other questions coming in, Sohail. So I think we'll wrap it up. It's 4 o'clock, and I want to thank everybody for joining us, and we look forward to seeing you at our next webinar, which I think is in January, if I recall correctly. And we'll send out notices to everybody who's attended this one as well as to other folks as well. Any final thoughts, Sohail, before we break off? Okay, I guess not. So we'll thank everybody, and we'll wrap it up, and wish you all the very best for the holiday season. Thank you so much. Take care.